So without further delay, let me introduce Mrs. Artemis Panagiotopoulou. Artemis is the CEO of EDECT Asset Management, and she's going to moderate the next panel. We're going to have two panels today. One panel is going to focus on Greece, and the other panel is going to be on international, more or less, issues, including Greece as well. And we're also going to have a subsequent session with three speakers again. Let me also share some good news with all of you. I've just been informed that we have more than 400 registrations from all over the world. So we're very happy. It seems that we're doing a good job. So Artemis, the screen is yours.
Great. Well, thank you, George, for the introduction. It's an honor to participate in IFFR's event and to moderate today's panel on the case of Greece. I have together four distinguished panelists with us, and apart from their impressive background, may I say that their names may also serve as a sign of their in-depth experience in Greece. So let me start the introductions with Mr. Chris Eshopos, CEO of Alpha Trust, one of the leading asset management firms in Greece, who also serves as the president of the Hellenic Fund and Asset Management Association, amongst others. Mr. Hercules Bablekos, CEO of Piraeus Asset Management, also one of the leading asset management firms in Greece, who is also board member of the Piraeus Group Occupational Pension Fund. We have also together with us Mr. Aristotelis Karitinos, CEO of Prodea Investments, a leading real estate investment company in the region with assets of approximately 3 billion euro. And Mr. Aristidis Protopapadakis, Managing Director of Systemic, providing financial software solutions and services in the fields of portfolio management, risk management, and regulatory compliance. Well, welcome to all of you, to our panelists. Well, we know that Greek occupational pensions have evolved significantly during recent years, and today we will try to touch upon key issues and challenges in terms of asset allocation, governance, risk management, and ESG from the Greek experience. So I want to start with, we heard earlier about asset allocation, the challenge of efficiently navigating the risk return. So let me start with Hercules. I'd like to ask you a question of how advanced are Greek occupational pensions in designing their investment policies and in exploring new investment ideas such as alternatives?
Thank you, Artemis. First of all, I would like to congratulate IFFR and Mr. Skiadopoulos for this great Congress, and I would like to thank him for the invitation to participate in this conversation. Alternative investments. Alternative investments, as we all know, can increase the diversification of the total portfolio and then can generate returns that are not correlated with the traditional asset classes. Despite that, by investing in alternative investments, we should be ready to address some specific challenges. Alternative investments may be relatively liquid. It may be difficult to determine the market value of the asset. There may be limited historical data. And the cost of the transactions can be relatively high. Having said that, let's try to calibrate a little bit the Greek market. What are we talking about? I will try to provide some selected facts and figures. The Greek occupational pension funds have assets around 1.9 billion assets under management, with 27, if I remember well, pension funds operating as we speak. From this 1.9 billion, 1.6 belongs to 4 occupational funds with defined benefit investment policy. The rest, 300 million, it goes to defined contribution funds, 23 out of 27. If we keep these rough figures, and combine that with a necessity of the pension funds to adapt new processes and cover operational needs that they are not ready to do it right now, we will probably reach to an easy conclusion, which is not right, but probably is the safe conclusion that the attractiveness of the investment theme will not be fully explored, especially from the group of the defined contribution occupational funds, the majority, the 23 out of 27. Why? Because they will avoid to participate in such type of investments due to limited resources and relative small asset base. Here is the first trap. These funds, in order to achieve better diversification, should explore the probability by investing in regulated AIFs and simultaneously reduce their operational burden. In contrast, the other category, the four with 1.6 billion assets under management, they can fully explore the universe. And actually, they do it in some extent. They have already invested in private equities. They have already invested in real estate or other real economy entities. So why that's happening? For me, it's simple. The second category have the motive, have the need to deliver better results in their investment, let's say, activity. And also they can deploy the resources. What I mean with the generic and the general term of resources. They can employ a fiduciary, they can have more than one asset manager to explore different themes or different investment strategies. And also they have the operational support for this activity. As we speak, I believe that we are in the middle of the process. And it's not a matter of robust investment policies or strategies or know-how. It's not a matter of know-how. We're in the middle of the process to enhance our abilities, especially in the area of initial due diligence and operational structure. Investment process and investment policies are already in place. We see that. The footprint in the market is relatively small, but it's not a matter that we don't have the policies or that we don't have the process. It's a matter of what is our ability to fund this operation because it has the specific peculiarities that I mentioned before. As we go forward, I think that as the market grows, the asset base will grow, the resources that would be allocated will be more, and that it will be good for the market and will help us to build up infrastructure and explore further any probabilities or possibilities in investment in alternative investments. And as far the asset management sector specifically, which is the sector that I represent here, we have to recognize that we have a deficit in people with specific know-how and specific skill set as far concerned the investment of alternative theme. And we have to employ more, let's say, resources in that, because currently we facilitate this need with investment managers that mainly have their experience and skill set in listed securities. Having said all that, I think it's a matter of the market. The market will grow, and as the market grows, all the market participants will take the necessary will go to the necessary steps to deliver best.
Okay, well, thank you. You touched upon quite a lot of issues that highlight challenges that we face. Obviously we'll be talking about those issues later on in the discussion, but I'll just say that you dived into the theme that we listened earlier to, alternatives. So alternatives are, include a variety of non-traditional investments, but real estate is traditionally an alternative investments. And we know that a lot of, many large global pension funds actually have real estate as a separate asset within their long-term investment strategy. So Aris, I know that you're the expert on real estate. Can you give us your insight on what the benefits are of including real estate in long-term investment strategies and what challenges does Greece face on this?
Sure. First of all, thank you for the invitation. Actually, I have to start with a significant distinction. Actually, there are two kinds of real estate investment. Is the indirect real estate investment, when you buy stocks of real estate companies, and the direct real estate investments. The difference is the indirect definitely is more liquid, definitely is it accommodates both long and short-term strategies, because as we all know, real estate stocks behave in most markets more like stocks and less like real estate assets. On the other hand, direct investments are much less liquid, and definitely it's a long-term game, yet especially in Greece are very, very challenging. Let's start with the benefits, first of all. I think the major benefit of the real estate investments is that they provide long-term stable income for the pension funds, which is very important for the stakeholders of the pension funds. And it's something that is very important in most of the cases. For example, if you have dividends from a REIT, if you have investment to stocks of a REIT, you get, you see a handsome dividend every year, which can range in our case, for example, between 5 and 7%. However, the challenges when we go to direct investments are a lot, especially in a country like Greece. Why is that? First of all, Greece is a small and very shallow market. That means that there are some major displacement in the market, some of which are the following. First of all, all of them are endemic in the market. They are not, you see, a product of the recent crisis. So it's something that we witnessed for many years now. First of all, low supply. Greek market had always low supply especially of real estate commercial product. And things have been worsened because of the crisis. Why? Because the crisis eliminated most of the very few big developers, most of which were hybrids, not exactly developers, because they kept most of the product for themselves. That means that finding investment-grade product is very difficult and very expensive in Greece, especially given the current market conditions with high development costs and high interest rates. So this is the case unless you become a developer yourself and you create your own product, which is the route that most of the REITs have now started to have, because it's impossible to have a decent return given the current situation of the market. The second displacement has to do with the lack of big corporate tenants, which is very important. This is because of the problematic structure of the Greek economy, because, you know, it's dominated by very small and small companies, which means that if you translate that in terms of real estate investment, you end up with smaller buildings, much more smaller meetings for a portfolio, or if you have a bigger building, to have a multi-tenant building. So this ends up to an intensive asset management case, which needs and necessitates to have a lot of real estate professionals, which is the third problematic characteristics of the Greek market, because we lack real estate professionals in Greece, especially now that there's a huge demand by the NPL managing platforms, which practically absorb most of this kind of professionals. So to sum up, yes, the major benefit is the steady income from especially both direct and indirect investment, yet a direct real estate investment, not being so liquid, it's much more challenging, especially in Greece.
Well, thank you for giving us an in-depth knowledge of practical challenges that the Greek market actually does face when it comes to real estate, which is a significant portion of alternatives. So I'm going to take it from there, and especially your reference to the need for stable returns, something that we request from diversifications, And I'll turn to Chris for a question on asset liability management, which is something inherent for occupational pension schemes, especially when it comes to defined contribution. So in terms of asset liability management, what techniques are applied by group pensions in order to hedge their liabilities? Do they use derivatives? Do they use a hedging portfolio when it comes to asset allocation? Can you please give us your view?
Sure. Before answering that, I would like to take a few steps backwards. The Greek pension fund system, especially the occupational fund, which is the second pillar, is a newbie. It's with us for approximately 1 decade, whereas in comparison to what's happening overseas, they're running occupational funds for many, many decades now. So they have made huge progress in terms of corporate governance, investment portfolio analysis, hiring managers, fiduciaries, etc. But the asset liability management is lagging what is happening at a mature stage in the world. In brief, asset and liability management is a process where we integrate assets and liabilities to inform decisions designed to achieve a sound and sustainable fund for the long term. So the goal of the asset liability management is to balance the expected cost of future pension payments with the expected future investment returns. During this process, the board with the investment committee review all the overall risks and take into consideration the long-term sustainability of the whole fund and system they're running. This is a formal process that they run for a multi-year cycle and includes reviews of investment portfolios and all the retirement plan liabilities that they have. So capital market assumptions are primarily based on expectations of future investment returns, whereas liability projections are based on demographic and economic factors, trends, membership dynamics, future salary and payroll growth, retirement ages, inflation, and surely life expectancy. So taking all that in a snapshot, they have to manage the asset liability under one roof. What's really happening in Greece is that we're far behind that level, and there's a liability management which is not using hedging techniques in the portfolio management system, but it's primarily whether you are maintaining or cutting pensions that you have to pay out. So it's something that you first see what's happening to your asset side and then decide what's happening to your liability side. They do not go together. So there's no one single asset management providing services to these funds today in Greece that does the whole wrap-up of ALM. Eventually, we will get there. It needs to be a broader education of how the funds, the occupational funds work, a pension fund system works, for the board of directors, especially of the funds, and then the asset managers and custodian banks and fiduciary providers will get in line with the whole thing.
Okay, well, thank you on that. Obviously, as ALM and all the parts involved is quite a complex issue. So let's turn to the expert on our panel on risk management and maybe technology. So Aristides, both asset liability management, risk management, and keeping up with regulatory requirements and governance issues are quite complex issues that can be alleviated through technology. My question is, to what extent do Greek pension actually use technology to assist them on that?
Yes, thank you, Artemis. We all know, in fact, that most pension funds in Greece, they outsource investment management to external professional managers. In that picture, risk management is often also outsourced, sometimes informally. And this, in their view, in the view of the pensions, might limit their need for in-house technology and other resources. Now, if you look at usage and alternative fund managers in Greece, outsourcing of services is quite rare. So where can we look for best practices? Well, from our experience in working with funds in other EU countries like Luxembourg, for example, their outsourcing is a common practice. So it's a place to look for best practices. In their case, European regulators do not allow a fund to outsource both investment and risk management. So if investment management needs to be outsourced, which is usually the case, then risk management needs to be done in-house. And this brings an important need for technology. It's still okay to outsource some calculations and analytics, but the basics of the job needs to be done inside. Now, in addition, the IORP2 directive seeks to improve the way that occupational pensions are governed. And this includes new rules on the IORP's own risk assessment. So under this directive, relying completely on a third party is no longer sufficient. A pension needs to do its own monitoring, needs to have its own mechanism, its own systems, and needs to prove to the outside world more ownership in regards to its managed portfolios. And this obviously becomes even more complex when different asset classes are managed by different people. For example, let's assume that a certain pensions equity portfolio is managed by our friends here at the Alpha Trust. Maybe they gave a fixed income to Piraeus, and maybe real estate is managed by Prodea, among us. Now, each manager will normally agree on a certain investment profile and produce a set of reports which are usually different with the other managers. So the question that arises here is, what is the pension's overall risk profile if we combine all the asset classes together? Under IORP2, the pension fund itself needs to be in a position to answer to this question thoroughly and convincingly, I would say. So in this context, on top of the more obvious subject of analytics and reporting, I would argue that technology helps pensions to integrate information from diverse instruments and coming from diverse sources into meaningful dashboards, thus allowing an IORP to conduct thorough governance and manage risks in a more meaningful way. For example, a pension can collect data from different providers, can reconcile this data with them, then maybe add its own market data from Bloomberg or Reuters or other sources, do some of its own calculations, and thus arrive at nice dashboards, oversight dashboards, which can give a good food for thought to their board of directors. Over to you.
You mentioned, several issues. I'll keep, what you said, which was very interesting. If you outsource asset management, then maybe you should do risk management in-house, which is quite important and, to the point. And also you mentioned, regulation, IR2. So let's talk a little about ESG now. It is widely accepted now that the ability to deliver attractive risk-adjusted returns over the long term also depends on sustainability factors. So let me return to Aris, our expert in real estate. And if you could give us a little insight on what about ESG in real estate investments, and are such opportunities available in the Greek market? If you could just, unmute, you're on mute, sorry.
Sorry, yes. So I think first we have to make again a clarification that ESG is not only about green buildings, about sustainable buildings, which is the first letter, it's energy. So it's not only that, it's also S, which is social, and it's G, which is governance. Actually, all of this is a very difficult reporting exercise and very expensive, I could say, proving that the company follows all these ESG principles. Coming to your question about E, which is the sustainable buildings, the effort of having, you see, green buildings in Greece is still in its infancy. Actually, in Greece, we don't have more than 100 buildings, green buildings, which is a drop in the ocean. You see, if you compare that with the stock of the buildings in Greece, which are thousands, you see, hundreds of thousands. So it's, this includes also, these 100 buildings include also special buildings like the New Opera House, the National Library, some schools, some nurseries. So actually, real estate investments in the area are less than maybe than 70 buildings in all. My company actually is the largest investor in the area. We own, you see, buildings with a value of 500 million, green buildings of 500 million, which is a very significant chunk of the green market in Greece. So it shows that how small the market still is in that respect. So can an investor can find, you see, green buildings in the market today, in the Greek market? Hardly, because of the lack of developers, as I said before, because this is the most pricey product, and if you find it, it's very pricey compared to you see, given today's conditions in the market, as I explained before, the high costs and the high interest rates. Yet, having said that, green buildings and ESG principles is the future of the real estate. A portfolio without green characteristics in the future is meaningless. You see, without the green characteristics. This means that all the old buildings that won't be converted will be obsolete after, you see, some years. And investment-wise, it will be again obsolete. So it's a one-way street to go to green. All our you see, future pipeline is green. It's about 1 billion and it's all green. Which means that we have no other way but to get green in the real estate market in Greece as well. However, having a green portfolio entails a very cumbersome and expensive reporting exercise. I don't want to be in detail, to go to details on that, but in order to be in the indices, you have to have a very detailed reporting about the consumptions and a lot of other characteristics of your buildings. So the more buildings you have, the more cumbersome this exercise is and the more expensive. But this is another factor that reveals how challenging direct investing can be, even in green buildings, because you need a very big team of experts, which again are very scarce in the market today. Actually, if you cannot find real estate experts, finding ESG experts is 10 times more difficult. Mm-hmm. So you get a feeling of how difficult it is. But as I said, it's the first steps. We're going, you see, we'll do much better in the future, I hope.
Well, very interesting. So green buildings are the future. Note what you reported, what you noted on the reporting exercise and the reporting requirements when it comes to ESG investments. Real estate is obviously very complex, but that holds for all type of asset classes. So let me get back to Aristides. Given the regulatory requirements, compliance issues, how have Greek pensions responded to the challenge of assessing ESG risk?
So let me first explain briefly what is a ESG risk, because we know what is ESG, but what is ESG risk? So ESG risk, which is another term for sustainability risk, it's the same thing, is the possibility of an environmental, a social, or a governance event that would have a negative impact on the value of an investment. Examples of ESG risk factors include, for example, environmental factors. Risk factors include energy efficiency. So how your electricity, how much electricity are your servers consuming, for example, waste production, and exposure to environmental hazards. Social factors include employee relationships, data privacy and security, selling practices, and false or maybe deceptive marketing. And governance risk factors include business ethics, compliance with legal and regulatory environment, internal controls, and risk management policies and procedures. All of these and many others can lead to serious problems, either at the level of the pension itself, or more importantly, usually, at the level of its investments. So the companies where the pension has invested in. Now, ESG risk is obviously not new. It has been there for a very, very long time, but it is only recent that all three European supervisory authorities, so the EBA, ESMA, and EIOPA, asked to incorporate this type of risk in a financial institution's risk management framework. So similarly to market, credit, and operational risk. And all that should be done via policy. We need to talk about measurement, stress tests, and all that. ESG in this picture. Now, you asked what are pensions doing today. I feel that they are doing the real minimum. It's only what is asked by the directives at a minimalized version of it. In this case, it's SFDR, the most relevant directive. So it's mostly a compliance exercise, I would argue. Yeah. But the roadmap looking forward includes a much broader picture, I would say, of ESG. I feel there is a growing pressure from the investor. So in this case, the employee, investor to the pension, from the pension to the external manager, etc., for sustainable investments. And I feel there is also growing social pressure in this aspect, particularly among the younger generations, I would say. Including my daughter, who asks questions about this, and other younger people. And this cannot be ignored. Now, will this bring improved financial results? Well, I would argue that because ESG entails risk, and we all know that we must deal together with risk and return, ESG brings volatility. So yes, it does impact the financial results. Mm-hmm. Now, how is ESG assessed? This is a tricky question, which is, I would say, under development in the market. There are questionnaire-based assessments, which are similar to an audit. So they ask you questions: how do you deal with energy efficiency? How do you deal with employee relationship, this and that? And this leads to a score at the end. But this leads to different results. So if you get assessed by different companies, you might get a completely different score. And also it lacks forward-looking aspects because it's an image of today. It doesn't speak about the future. And then there is the risk modeling approach, where we try to model and to measure the probability of a future ESG event in a similar manner, I would say, like we measure credit risk. So in this way, the ESG risk factors can possibly be incorporated in the value at risk calculations with the volatility and correlations with other risk factors. So to close, I would argue that we know that an ESG event is probably rare, and a credit event is also quite rare. But we all know that credit risk must be measured and managed. So why not ESG risk?
Well, it seems that multiple risks actually have to be measured, and we've heard earlier in the discussion both about asset managers, outsourcing, insourcing, different asset classes. So I'd like to return the conversation to governance, and I have a question for Chris. How do Greek pensions address the complex relationship between trustees, investment committees, and external asset managers in order to ensure a consistent approach to achieving their investment objectives?
Thank you, Artemis. I think I'm having the most hard question yet, but let's summarize what's happening in the Greek environment. The Greek law does not accept fiduciary duties in the sense that is common in the British law. So by fiduciary duties, all these pension funds literally imply a central administrator, portfolio manager that does all the aggregation of the accounts and also provides the data of performances, risk-adjusted returns, etc., that the fund, along with the board of directors and the investment committee, will review. So it's a different kind of fiduciary duties. Still, it's a body that controls and provides all the analysis of what's going on in the asset management side of the portfolio, as it purely focuses on the asset side and not on the liability side. Then you have the board of directors of the fund responsible for everything, of course. You have the investment committee, with all of the members have to comply with the regulations set by the Hellenic Capital Markets Commission. So they must be knowledgeable of what the asset managers and the actuaries are doing. And then you have the asset management companies that do the portfolio management. So you have the board of directors that knows the liabilities, and along with the investment committee, they set the strategic asset allocation, which is supposed to be a very long-term asset allocation, addressing the issues they have with the ALM structure when they were launched. And you have the asset managers that do the tactical asset allocation according to the investment committee guidance and the portfolio targets and way to maneuver around benchmark. So these work well. You have a very proper corporate governance of the whole fund. You have nowadays two investment professionals in all steps, not necessarily in the board of directors, but necessarily in the asset management side and also in the investment committee. All of them work hand by hand. But in order to see some fiduciary duties that we're accustomed to seeing overseas, I think that will evolve over the time, and it's not the time yet to see those duties. So that's the basic framework that they operate. Let me remind you that 20 years ago, nothing of that was around us. Everything started approximately in 2012. The progress is immense. We must congratulate all the regulatory and legal environment around them, along with the board of directors of all the funds that comply with them. And just see the evolution as the years go by in order to become mature in the way they operate.
Great. Well, thank you on that. And I think we have time for one last question. So I'll return back to Hercules, who started the conversation. And just, 3 minutes, if you can give us your review on, given the characteristics of the Greek occupational pension market, what are the largest challenges they face today in terms of, we heard earlier, small size, and not that much experience in terms of time, although they have progressed significantly, governance, and also in addressing the home bias issue, maybe.
Yeah. The industry mapping that I outlined previously leads to a hard conclusion. Size matters. We need larger entities in order to achieve economy of scales and optimize the allocation of resources to achieve better risk-reward results. So yesterday, not today, yesterday, we should have in place the legislation for multi-employer funds, that it will allow to the smaller funds to consolidate and give them the opportunity to employ more resources to their operation. They will hire a fiduciary, they will have more than one asset managers, so larger structures will enable for behalf of the people that they are in the pension funds, will enable opportunities no easy visible at the current state. All of this will lead up to a better results for their members. So we need the legislation for the multi-employer funds, and also it will be nice, and we have said it before, that we need to speed up the process in order to be more accessible to more easier and more quick to launch up a new occupational fund, which now we know that it takes roughly 1 to 2 years to end up with your license. And that will happen if we have a common supervisor. I believe, and I would like to believe, that the legislation will go forward, and we finally will see what the bill that we are discussing for at least the last 1 year. As far concerned the home bias issue, it's a little bit tricky. In my opinion, there's no home bias whatsoever. What we are seeing is that almost all occupational funds have mandates with global asset allocation. But what is happening, it's the Greek peculiarity. The Greek peculiarity is something that I hate to mention, especially when I'm in an international forum, but I'm sure that we all agree that Greece right now offers a unique combination globally. It is characterized as a non-investment grade country. It's more like to the area of emerging markets, but at the same time, we are members of the European Union and we have a single currency. So at the moment, for me, Greece offers a unique investment opportunity that we cannot afford to miss. We should explore it till the last, let's say, aspect of this opportunity. We know that the goal of Greece right now, the main goal is to achieve to be investment grade rating. So if you combine where we are, what is the main target, and where we're heading, I think that's not a matter of home bias, but it's more a matter of investment choice. Why? And therefore, where the asset manager have to decide if we'll invest in a company, a European company or a Greek company, combines the balance sheet, and he ends up that both companies are investable and they can offer opportunities. Why not to select the Greek one that offers a premium, which is not premium of the company, it's country premium, more rather premium of the company. So when the opportunity ceases to exist, then we will really know if there is home bias or no. At the moment, I think that it's not home biased issue.
Okay. Well, thank you very much. Unfortunately, our time is up. We do have 2 questions from the audience, which unfortunately we won't have time to address. So apologies for that. But I'd like to thank you all for a very lively discussion. I know that we touched upon a lot of issues, and definitely the Greek occupational pension market has done a remarkable job, I would say, during the past years as it's progressed within a very demanding global market. So thank you to all of you, and I pass the floor back to George.